Welcome to Stat Plus, where we help you have smarter conversations on India's economy, emerging technologies, and market trends. Our mission is to provide analysis that sparks meaningful discussions wherever you go, whether it's at work, school, or catching up with friends over coffee. In today's video, we're exploring a timely topic, rethinking RBI's inflation target. With CPI inflation recently spiking due to food prices, we'll look at why the Reserve Bank might benefit from a more focused, economy-driven inflation metric. This change could have far-reaching effects on monetary policy, economic growth, and investment climate. The October CPI inflation numbers once again highlight the significant skew caused by vegetable prices, which have surged by 42% year over year. The stock market continues to trade lower, with the added concern being the headline CPI increase of 6.2%, breaching RBI's upper threshold of 6%. However, this overshoot is primarily driven by food inflation at 10.9%. As we've discussed in previous posts, food inflation isn't typically responsive to interest rate changes, given that essential food demand is inelastic to price movements. Consumers don't materially adjust their consumption of core grains and vegetables based on prevailing prices, since food inflation is mainly influenced by factors such as weather conditions and government policies, such as buffer stock management, import-export restrictions, and duties. It shouldn't ideally be the metric that guides Reserve Bank's monetary policy decisions. To better assess price movements in the economy, it's crucial to focus on core inflation, which excludes food and fuel categories. This would provide a clearer picture of price trends for economy-driven items. That is, those items for which net demand is directly linked to India's economic performance and markets. For instance, fuel inflation, determined by global crude prices and related government policies, is also excluded as it isn't determined by India's economy and markets. Core inflation for October, excluding food and fuel categories, stands at 3.68%, marginally above September's 3.52%. This slight uptick is primarily attributed to the rising prices of gold jewelry and other ornaments, included under the personal care category within core inflation. These jewelry categories carry a weight of approximately 1.1% in the overall CPI basket. Gold prices saw a significant increase of 8 to 9% between September and October. Considering that making charges also move proportionally with gold prices, this category has contributed to the 16 basis points increase of core inflation in October. Overall, given that inflation for economy-driven items within the consumption basket remains well within the RBI's target range, it may be prudent for the Reserve Bank to proceed with the anticipated rate cuts to support GDP growth. Lower rates would not only help stimulate economic activity, but could also provide a much-needed boost to stock markets, fostering a favorable investment climate. The key takeaway here is that the RBI should target a metric focused only on the prices of economy-driven items. For example, only those items for which net demand is directly influenced by India's economic performance and markets. By aligning policy interventions with such an economy-driven price indicator, the Reserve Bank can better manage inflation and support economic growth. That concludes our deep dive into the case for an economy-driven price index for the RBI. Here at Stat Plus, we aim to make complex topics accessible so you can have smarter conversations wherever you go. What are your thoughts on this? Should the Reserve Bank revise its inflation target, or does the current approach hold up? Let us know in the comments below. If you enjoyed this video, please like, subscribe, and hit the notification bell to stay tuned. Let's keep the conversation going. See you in the next video.